Hello and welcome to the Inheritance Tax Planning Using Whole of Life Plans webinar from Royal London. My name is Adrian Bates, Corporate and Estate Planning Protection Specialist, and I will be your host today. Today, we will look at some ideas on positioning inheritance tax with clients, what it means for them, and also some ideas to demonstrate the value of guaranteed whole of life plans. And I'll introduce you to a facility to get valuable cover in place quickly using Underwrite Later. I'll then hand over to my colleague, Dave Dawson, who will run through an idea using whole of life plans in the equity release market. So the learning objectives from today's webinar are: so talking to clients about legacy planning, obvious that the conversation needs to start about what inheritance tax specifically means for them. And where I'm coming from here is that experience has taught me that people know that death duty is a thing, but they don't necessarily have receipt of all the facts about inheritance tax, so are therefore unlikely to do anything about it. So making sure clients understand what reliefs and exemptions apply, for example, specifically to them. Is there a transferable nil rate band available? How does it work for them? The residence nil rate band, is that applicable? This is a particular thing, the residence nil rate band, where you hear lots and lots of different things about it. Making sure they understand if it's available. First thing, of course, that people need to understand is that the residence nil rate band is only available if you leave your property to lineal descendants, and they are, of course, children and grandchildren. So if you don't have any of those, then the residence nil rate band will not be available to your executors. And also making sure clients with estates that are worth over £2 million, make sure they understand that the residence nil rate band starts to disappear. You start losing £1 of the residence nil rate band for each £2 that your estate exceeds that £2 million benchmark. And actually, for a couple whose estate is worth more than £2.7 million, the residence nil rate band is lost completely. And of course, how much IHT are we actually looking at? You might be interested to know, if you haven't seen it before, there is a very useful website that HMRC provide. I've put the link up there for you, that is designed to help executors work out whether or not IHT is potentially payable on an estate. So it asks lots of questions that are relevant and gives you lots of links to various reliefs, exemptions, and other useful information. So making sure clients understand what IHT means for them gives us then the foundations on which to develop our subsequent conversation. And what we can do as well is dispel any myths around IHT. And one of the big ones is people thinking it doesn't apply to them. It's something the rich need to worry about. Well, yes, of course, the rich do need to worry about it, but so do people that perhaps don't consider themselves to be rich. And a lot of the problem stems from the value of property, which of course is included in the estate when valuing for IHT. Most people's biggest asset that they'll have to pass on, or that they hope they'll be able to pass on, is their home. And in February this year, the average UK house price exceeded £275,000. Depending where you live, it's going to be a lot higher. And if you've only got access, your executors, to the personal nil rate band of £325,000, for a lot of people that will be the case because you're not married, you don't have children, for example. You've already used up the vast majority of it. So you don't need a lot more stuff in your estate before a cheque is being written out by your executors. And you only have to look at how much money is flowing in to the Exchequer's coffers to see that this is big business for the government. Receipts over the last 20 years have doubled. In 2021 exceeded more than £5 billion. It was actually £5.4 billion. And we've just had notification recently of the receipts up to the end of the tax year this year, March 2022, and receipts have exceeded £6 billion for the first time. It is confidently forecast that receipts will exceed £8 billion by 2026. 2027. So this is big business. You can see there was a dip in 2008, 2009 due to the financial crisis at that time. The value of stuff went down, property, savings, etc. But then the world recovered, so the value of things went up again, as did the inheritance tax receipts. In part, that was due to the government freezing the nil rate band at the time to £325,000, which again has been frozen at March last year to at least 2026. So of course, as the value of assets increase, but the nil rate band doesn't, it does mean more people getting caught in the trap, and people already paying, subject to IHT, will be staring at bigger bills. And what size are we looking at? I mean, of these bills? Well, you could have a modest value of an estate at £600,000, and if all your executors have is access to your personal nil rate band, they're writing out a check with six figures. And how are you going to pay that, particularly if that 600,000 estate is mainly made up of your home? Options do clients have once they're presented with the facts about IHT? They can make a decision on what to do. But what options do they have? Well, one of them is actually to do nothing, which is what obviously quite a lot of people decide to do. I mean, it means obviously that the IHT is still due on death, but at least they're making that decision based on the full facts rather than hearsay and what have you. They could enter into gifting strategies. They could give things away. For a lot of people, that's not practical. If your house is taking up the vast majority of the value of your estate, then you can't give parts of that house away. So that's not something that certain people can do. There are specialist strategies, loan discounted gift trusts and the like. But again, not everybody has the lump sums or are willing to invest lump sums into these products. So what's left? Well, it's providing the money for the beneficiaries to pay the bill. This is where, of course, life assurance comes into play, particularly whole life. Guaranteed whole life, which we offer at Royal London, is really the go-to product for a lifetime IHT liability. We offer reviewable rate contracts as well. Rates are guaranteed for 10 years and then reviewable at that point and every 5 years thereafter. We'll look at reviewable whole of life policies a little bit closer later on. But where the guaranteed, over and above providing the money to pay part or all of the IHT bill for your beneficiaries, what other role does whole of life play? Well, it's important, of course, to understand that executors who are responsible for dealing with a deceased person's estate, they can't actually distribute the estate's assets, which is what their main job is, and if there's a will until probate is granted. And the issue here is that HMRC will block probate until they've been paid the IHT. And if you don't pay them within 6 months, there's going to be interest charged. Now, if you, as we said earlier on, if your estate is mainly made up of your property, your home, getting your hands on the money could be a bit of a challenge. Ultimately, if you haven't got it, you're ultimately going to have to find a way of borrowing it. Well, whole of life comes to the rescue here, a bit like the cavalry coming to the rescue, because we write the policy in a trust, because it is written in a trust. You don't have to wait for probate. The money can just be paid to the trustees, presumably the same people as the executors, so that they can pay the IHT to HMRC, unlock probate, and get on with the job at hand, which is distributing the estate's assets. But you all know, if you've ever been involved in a conversation with a client about guaranteed whole of life in particular, that the cost can be a major problem here. And what happens is we give the client a quote for whole of life. Here's a way of producing the money to for your loved ones to pay the IHT bill, and they see the quote. They're not expecting a premium anywhere near that amount, and the barrier of price, as you know, goes up. And you all know that it's a really difficult barrier once the price barrier is in play to get over. And so I think there's other ways that we can approach positioning the cost of whole life here by demonstrating the value of it first and making sure that clients understand what it is we're buying. If you put yourselves in a client's shoes, would you actually buy something with a big price tag that you didn't understand? Well, unlikely. So it's pretty unlikely that clients are going to do that either. What they need to understand is what is whole life. They may have heard of it, but they don't know what it is. To them, it's life assurance. And life assurance, for most people, their default view of it is quite naturally term assurance, because if they've ever interacted with life assurance during their life, it'll be term assurance. Because, for example, 30, 40 years ago, they took out their first mortgage and they probably took out some decreasing term assurance. What do you associate with decreasing term assurance in particular? Relatively low cost. We now give them a premium for a relatively modest sum assured. They're expecting it to be higher. They know age is a big part of the cost of life assurance, and they're much older than when they bought their last life assurance, but they're not expecting it to be that much. So they need to understand, as I say, what whole life is and what it isn't. It isn't term assurance. Term assurance pays out if you die during a specific period of time. That's unlikely to happen, hence the relatively low cost. Whole life pays out when you die, which of course will happen. We know this, but it's not necessarily obvious to clients. It's a subtle difference in language, but it is a massive difference in product. It really is like comparing chalk with cheese. One pays out if an event happens, the other one pays out when that event happens. Completely different. Another way to articulate whole of life, to get clients to really understand how it works and what you're asking them to consider buying, is imagine you've got clients with an IHT bill of £500,000. I'll be introducing you to some clients in a minute that have that IHT value bill, £500,000. Would you be interested in a way of producing that £500,000 immediately without any risk in respect of interest rates, fund performance, etc.? If I could show you a way of doing that, would that be of interest? Well, that's what whole life does. The moment you're on risk, whether it's single or joint life, that amount of money, £500,000 in this example, is accrued instantaneously. The money's locked in a vault. The clients can't get their hands on it, but of course it's not for them, it's for their loved ones. And their part of the bargain is to pay this amount per month. Think of it as a small amount of your IHT bill that you're paying off whilst you're alive. But you pay this amount per month. It's not going to be free. You've got to pay this amount per month just to keep that money in the vault. And the other part of the bargain that you're entering into is that you die at some point in the future, which of course will happen. And then that vault is unlocked, and the full amount of the money you want your loved ones to have to pay the IHT bills so that they get their full legacy, or as much as possible, it's presented to them in full without any deduction. Let's introduce you to Bob and Maureen. I say they've got a liability at the moment that we've calculated at 500,000. They're 62 and 60, cautious attitude to risk, and they do want to ensure their children receive their full inheritance. They've considered their options, and the one that fits them best is providing the money to those beneficiaries to pay the bill. So they have the option of a guaranteed whole life plan. And we've explained to them what a whole life policy does. We've articulated it, they understand it, and we've given them the quote. And naturally, of course, they're going to think £871.53 is expensive. That would be the cost for Bob and Maureen for a Royal London guaranteed whole of life plan. The other option they're going to have, of course, is to create that £500,000 pot some other way. And that would be using a separate savings account, coming up with a pot by saving a certain amount of money. And we're going to assume, in an example that we look at now, that they're going to do this in a bank account. So what we've done at Royal London is we've developed a calculator that can help you demonstrate to clients the major disadvantage of saving to create a lump sum against a whole life plan. And it works like this. At the top on the left, there's the premium £871.53. What I'd ask you to do at the moment is actually the cost will park to one side. Whether or not Bob and Maureen can afford that amount of money is a moot point. They might not be able to commit £871 to any strategy. What we're doing is demonstrating the value of a guaranteed whole life plan. We'll come back to the cost a little bit later, but that's the cost for 500,000, and you can see with my cursor here that whole life sum assured is represented by this horizontal orange line here. Okay, so right from the start, once they're on risk, that £500,000 is in play. Now, based on the insured population, we would expect a claim under the whole life policy, so the death of the second of Bob and Maureen at 32 years, which is represented by this vertical red line here. So how long would it take Bob and Maureen to save £500,000? Well, we're going to give them a 2% compound interest rate at a local bank account, which is quite generous with interest rates. I know they only went up recently, but 2% is still quite generous. But we're making a point here. So we give them a 2% interest rate. It would actually take them on with this blue line that represents the savings pot. It would take 34 years of saving the same amount of money as the premium to accumulate £500,000. They're expected to both have died by 32, so £500,000 won't have been reached. In certain circumstances, depending on the parameters that you put into the calculator, that blue line could actually cross the sum assured before they're expected to die. But again, it doesn't matter. The point, of course, and the difference between the two strategies is shown by that shaded area. It doesn't matter what savings, how you save the money, whether it's a bank account or whatever it might be, you're going to have a shortfall. You're going to have a shortfall until that pot is actually achieved. That's not the case for whole life, because the amount of money that you want is achieved from day one. So, for example, if you made a couple of deposits in your bank account of £871 and then died in a car crash, both of you, what you've produced for £871 a month is about £1,600, £1,700 towards that bill. For the same amount of money, whole life has produced £500,000. This calculator can be found on our website. So if you go to advisor, use your website address, which is advisor.royallondon.com, select protection tools, and then you'll see various headings. If you select during your client meeting, you'll see various calculators available to you, and you'll see that the guaranteed whole life value calculator is listed there. You're also able to download a PDF of what I've just shown you for use with your clients. Additionally, what I've shown in this example, it's not on the calculator, but what I've shown in this example is if you are saving in a bank account, of course, if your estate is liable to IHT, so will the funds sitting in your bank account. So this shaded area, this extra shaded area, is how much that needs to be going to the taxman. So actually, the blue line would need to be where the grey line is. So a much worse situation. If you think about it, each time you're putting in the £871 into your bank account, you're actually creating two pots, aren't you? 60% of that money is going towards building a pot for the your loved ones to pay towards the IHT bill, and actually you're creating a nice 40% little nest egg for the taxman. In contrast, all £871, all of it for whole of life, goes towards maintaining that £500,000 in that vault. The other thing worth pointing out actually here as well is if they do live for 32 years, what's the likelihood of that bank account remaining untouched? Not likely, is it? Chances are there'll be little bits taken out of it during those 32 years. Unexpected bills, I don't know, repairs to a leaky roof, you've got to find £15,000, £20,000. You haven't got the money, then you realise, yes, we've got that IHT savings thing. So in your hand goes and you take the money out. It's very unlikely that that's going to remain untouched over that length of time. Of course, another plus for whole of life here is that you can't put your hands in to the whole of life money and take it out because it's locked to you. It's only available to your beneficiaries on your death. So when you die, again, worth reiterating, the full amount of money that you want to go to your loved ones will be presented to them exactly how you want, without chunks taken out. In conclusion, the whole life plan, of course, provides the full £500,000. And that's whenever death occurs, whether it's the day after you're on risk or years into the future. And it's as long as you pay the premiums, obviously, it pays out. And the premiums are guaranteed not to change on a guaranteed whole of life product. You don't have to worry about any fluctuations in markets, interest rates, etc. And of course, good idea is always to link solutions back to what the clients want to happen, which in this case is getting as much of their legacy as possible by providing the money to pay the IHT bill. It's exactly what this does. So Bob and Maureen's objectives are met. Guaranteed whole of life provides certainty of cost, certainty of access, because we get the money quickly without having to wait for probate to the trustees, and you know that the sum assured that you've earmarked for your beneficiaries is going to be what they receive. Now, I mentioned reviewable whole of life, and I say we offer it here as well at Royal London, and the obvious attraction is the cost. If Bob and Maureen's bought a reviewable premium whole of life policy, it would actually cost them £67.22 as opposed to £871.53 for the guaranteed. Well, of course, that premium will go up in 10 years and every 5 years thereafter, mainly due to your age. So where do we see uses for reviewable rate whole of life plans? Well, mainly where it's being used, where cover's needed in respect of the advisor working with a client to reduce their liability, where there's a short, medium term IHT liability, so not a lifetime liability. Yes, you could use term assurance. I hear that a lot, but what if things don't go to plan? One of the things you can do, of course, with a whole life plan is just keep it going for as long as you need. It gives you that little more wriggle room if things don't go to plan and there's still an IHT liability in the future. And you can, of course, reduce the amount of cover in line with the reduction in IHT on our plans as many times as you like. So that might go some way to offsetting future increases in premium due to the reviews. What we also see at Royal London are clients buying a guaranteed and a reviewable rate whole of life. Now we go back to Bob and Maureen, where I asked you to just put aside the cost at the time, which was £871.53. If we've articulated exactly the value of whole of life, how it works, etc., it could be that clients then think, well, yes, that's exactly what we want. That's better than savings. Of course it is. Yes, we'd like to buy a whole life policy, but we cannot commit to £871. So the natural conversation then is to ask the client, well, what can you commit to? What is your budget? So let's say Bob and Maureen suggested £500. All I did was I just had one go at this. I just decided, well, let's cut the sum assured in half and do half guaranteed, half reviewable, and see where that gets me. And what we got was 250 guaranteed for £440.51 and 250,000 reviewable for £36.87 for the first 10 years, bringing us nicely in under their budget. Yes, the reviewable rate premium will increase after 10 years, but in respect of 250,000 the cover, not all of it, if they'd gone the whole 500,000 as reviewable. This is, of course, just an example of combining guaranteed and reviewable rates to meet a client's budget. You're absolutely free to try different combinations to suit a client's particular circumstances. So you've got a whole life policy, you've got a whole life plan, and you're thinking, right, I've got to get these clients through underwriting now. And you'll know as well as me that underwriting can take a while, depends on the circumstances of each case. Older clients will have potentially had more medical issues, so maybe it takes a bit longer. With whole of life, I don't know what you feel about that, but that feels about right. Well, one of the things that we've decided to do at Royal London is put in a solution to try and help your clients and yourselves here by extending underwrite later into the whole life market. It's been around for a while now in business protection and relevant life. So you may be familiar with it, but allow me to explain exactly what this is. It's full cover. We issue the policy as if we've been through underwriting, terms have been offered, and those terms have been accepted. So we assess the application if you ask for underwrite later. As long as we can accept the clients up to a maximum of 100% rating, we will go on full cover, no exclusions as a result of this facility. Okay, this isn't free cover, this is full cover as if we've underwritten the case. And currently it's for cases between from £500,000 up to £3.5 million. It's available for guaranteed and reviewable rates. And just to point out, I had a case recently where 2 applications to meet a client's budget, the idea that we just shared, we had 2 applications that individually were below 500,000, but collectively exceeded 500,000. We were able to offer underwrite later for both those applications. There's no maximum age. Now, if you just think about that for a minute, the average age of people that you're going to have legacy conversations or are having those conversations with, they're going to be late 50s, 60s, 70s. Free cover that other companies offer, I mean, we offer it as well, but free cover often doesn't apply, for example, over 60. So an awful lot of your clients in this space aren't going to be able to qualify for it. But they can for full cover under Underwrite Later because there is no maximum age. I think that's a really important point to make. And you have 6 months to get through the medical underwriting. Vast majority of cases, that's more than enough time to complete the medical underwriting. Remember, it's for joint and single life cases. So both, if you joint life, second death, both lives can benefit from this. But there's 2 areas where Underwrite Later produces some really good outcomes for your clients, but aren't immediately obvious. The first is you're locking in your client's age. If you're not on risk whilst underwriting's taking place and your client goes through a birthday or a half birthday, or with some providers a quarter birthday, the premium's going to go up. That's how it works. And if you're talking about clients in their 60s, 70s, if you're talking about guaranteed whole of life, they could be extremely significant increases. Well, that doesn't happen with Underwrite Later because you're on full risk. Your premium, client's premium will not go up as a result of their age. So if you know that you've got a client that's going to go through some sort of birthday or both of them during the underwriting process, you might want to find out what the premium would be after that birthday and compare it with Royal London's premium now, because ours will not increase due to your client's age. And in the same logic applies to your client's health. If you're not on risk, you're obviously your clients are under an ongoing duty to disclose any change in their circumstances. And that will mainly be health. And if something happened to your client whilst they're in underwriting, a medical episode of some description, it could result in an increased premium due to a rating. You could have a postponement of cover in the underwriting until whatever it is that's occurred is investigated, with whatever the outcome will be of that, or worst case scenario, there could be a declinature. With Underwrite Later, that doesn't happen because your client's on risk. There is no ongoing duty to disclose a change in circumstances. So that would have no impact at all on the cover. I think they're 2 really important points that Underwrite Later provides value in respect of your clients. And worth pointing out that commission is paid in the normal way there. For more information, visit advisor.royallondon/underwrite later. The address is on the bottom. So what I'd like to do now is hand over to my colleague, Dave Dawson, who for the next 10 minutes or so is going to talk you through an idea using whole of life plans in respect of the equity release market. So Dave, good morning to you.
Thanks, Adrian. Welcome, everybody. And yeah, I'm going to take you through a very simple idea, but I think a useful one, and one that has been accepted by a number of intermediaries and welcomed. You can see on the screen here, I'm introducing a different couple, Bill and Wendy. They're going to be the couple who take out an equity release roll-up lifetime mortgage. Now, I've spoken to some people who are involved in the equity release market, and they tell me that this is a common way of occurring. So a roll-up lifetime mortgage means that there are no repayments, no interest. It's rolling up, and it will be repayable potentially upon the second death. Now, Bill and Wendy in this case have got a couple of sons. Bill and Wendy are the people who are non-smokers, and they're going to do an equity release of 100,000. Now, when I was doing this research, very much similar to what Adrian talked about a few minutes ago, where he looked at the IHT receipts, which for the last year exceeded 6 billion, but in a few years' time are expected to go to 8 billion. Well, everything I've been reading is that the equity release market is expected to explode and to really increase. So I like this idea. I think there's merit in it. But as I say, for the purposes of this example, we've got Bill and Wendy, they're releasing 100,000. What they do with that money is entirely up to them. And the example here is that they're going to use the money to get rid of their mortgage. They could gift it to their sons and help them to get on the property ladder. It doesn't matter. But in this particular example, the interest rate that's attaching to this equity release is 4%. Now, this idea does use a few numbers, and however, but the first of which is, when do we expect the second of Bill and Wendy to pass away? So we're using the same insured database that Adrian used when he was looking at the value calculator, and we expect that the second of Bill and Wendy to pass away is in 27 years. It's important then to have an understanding of what the £100,000 debt would have grown to through compound interest at 4%. And you can see the number there, it's 288,000 plus change. Now, at this point, let's take a bit of a step back. We've got thousands and thousands of Bill and Wendy's taken out equity release plans, roll-up lifetime mortgages. You look at the literature that goes with these. I've seen some, and it's pretty much a done deal that the way that this 288,000 is going to get repaid is by the sale of the parental home. And there's absolutely nothing wrong with that. And however, that's fine. But this idea is about time and choice. And however, because how do you get your hands on the property and then put yourself in a position to be able to sell that property to be able to repay the debt? Well, we just listened to Adrian there, who talked about the time scale for having to repay inheritance tax, 6 months. And then if you're delayed beyond that, you're going to get hit with interest rate penalties. And whether so, could the sons get their hands on that property quickly? And if they're selling it, are they selling it at the right time? Now, one of the other aspects that is very, very important, we're talking about the emotional side here. The parental home could have all kinds of sentimental attachments to the sons. It could be the last thing in the world that they want to do, or one of them might want to hold on to it and the other one don't. So having an alternative mechanism to repay the equity release debt could be extremely interesting, primarily to the sons. Okay, so is there an alternative way to get rid of the equity release debt? And the answer is yep. No great surprise there. You've already guessed it, I'm sure. Bill and Wendy, at the time that they're doing their equity release roll-up lifetime mortgage, are advised by yourselves as financial advisors to consider taking out a joint life, second death, whole of life plan. We're back with our guaranteed premiums. It's written under trust for the benefit of the sons. The sons are likely to be the executors of the estate, but they're also the beneficiaries of the trust, which will receive the whole of life payout. And because we are doing this at the time that we're doing the equity release, the sum assured is the mirror, it's the 100,000, and the sum assured will keep pace with the equity release debt by increasing at 4% each year. Now, I said there were a lot of numbers in this idea, and so we've got some more here. A mechanism, the technical part of the product is that the premium will increase at double the sum assured increase. So the premium goes up at 8%, but it starts at £208.91. Now, an important point here, there is commission payable on the £208. An awful lot of advisors that I speak to will say, you know, maybe got a 6 or 7 RI firm, could be very similar to your firm, where not everybody is authorised to do equity release. So if you're passing that equity release product to somebody else, they're getting the commission for doing the £100,000 equity release. The client's still your client, but if you're not doing a whole of life, then you're not getting anything out of it. But if there's £208.91 whole of life premium being put in play by yourselves, then you're getting a bit of commission. So there's something, some remuneration for yourselves. But let's consider some numbers. We already know the sum assured increases to 288,336, but we've got to consider the premiums. Does that represent good value for money? So the total premiums from 208.91 up at 8% grow to 217,000. So when I look at that, I think to myself, yeah, absolutely, that represents decent value for money. So total premiums 217,098. So the final slide in my short slot here, some advantages. The sum assured is available quickly. Now, there's an interesting point that we have to bear in mind. Let's assume that Bill and Wendy's total estate was worth 1.2 million, and we assume that there are 2 unused nil rate bands and 2 residence nil rate bands available. You know from the conversation earlier with Adrian that adds up to a total exemptions of 1 million. What we've also got is a debt of 288,000. So when you see equity release information, an awful lot of it will talk about one of the advantages of an equity release debt is that debt will reduce the size of the estate and potentially save inheritance tax. Well, in this case, if the estate was worth 1.2 million, that's exactly what would happen, because the 288,000 would actually be combined with the £1 million worth of exemptions, and we wouldn't have any inheritance tax. But guess what? We've got this whole of life plan in a discretionary trust that the sons are the beneficiaries and trustees of. They're also the personal representatives. So what they can do, and this is the clever bit, is that they lend the 288,000 from the life policy trust to the estate, and they use that money to get rid of the equity release loan. Now, you might be thinking, can you do that? Because that's what I thought when I was working on this idea. I thought, can you actually do that? So we checked. We spoke to equity release lenders, and the answer is yes. They don't really care where the money comes from. So this money is available fast. The life company make the payout, and the trustees lend the money quickly, and they send the check off to the equity release company. End of equity release debt. And that's important, because the quicker we do that, the less interest is rolling up on that 288,000. So fantastic. We've got rid of the equity release debt. Okay. Now, that is extremely useful, but we've got to remember that debt is useful because we've done this. We've got rid of the equity release debt before we've made the inheritance tax calculation. We need a debt to be in place. Well, the debt is still there. Instead of it being a debt to the equity release lender, the estate have a debt to the trust. So that debt plays its part. It reduces the estate for IHT purposes. Now, whilst that debt's still there, there is an obligation on the personal representatives to repay the loan, because until estate debts are repaid, the estate is still in administration. Okay, so they've got to do this, and they've got to do it reasonably quickly. So how would the 2 sons effectively repay the debt to the trust? Well, it depends on the wills of Bill and Wendy, where they've left everything. But you've got to remember that there's a house here, and however, that's been left. So if there's liquid cash, that can be transferred into the trust to get rid of the debt. If not, then assets to the value of the 288 can be transferred into the trust until that debt is repaid, and then administration can be completed. As you can see there in that 3rd bullet point, if the property is sold, then the sons will repay the money to the trustees, and that will be held for the benefit of any beneficiaries. Clearly, if they want to maintain the ownership of the house with one of the 2 sons, providing they can move other assets and get rid of the debt, then that's absolutely fine. What we're talking about here is time and choice. And I personally think for 217,000, that's well worth the money. Thanks very much. Back to you, Adrian.
Thank you, Dave. So to summarize the opportunities that you have here in the legacy market, you've obviously got your own clients, individuals, couples that you can have IHT conversations with. And as we looked at the beginning, ensuring that these clients understand what IHT means for them, so they've got the full picture. Then you can introduce the strategies to do something about it. You've obviously got the beneficiaries as well, as they've got a vested interest in this. So why not include them in these conversations? And indeed, why wouldn't they end up being future clients of yours if they're not already? And of course, once they've inherited, they're potentially going to have IHT issues at some point in the future, if not straight away themselves. So they'll be looking hopefully for some advice in this respect, in respect of what they leave for their own beneficiaries. And also, it's another one of those markets like business protection, where there's a great opportunity to develop relationships with professional connections, because there will be solicitors and accountants involved, and of course, trustees of the whole of life plan. So there are the learning outcomes from today. So that's it from Dave and myself today. Do hope you enjoyed the webinar. Do hope that you can take away one or two ideas from it. And last of all, many thanks for joining. Thank you.